Welcome to Talk Tickers, where today we are diving into Aircastle's Q2 earnings. And let me tell you, this was not just a solid quarter. This was a textbook example of a company hitting its stride at the absolute perfect time. Aircastle is really firing on all cylinders, and the results? Well, they speak for themselves. So let's get right into it.
First up, the headline numbers. And really, these figures set the stage for what was a total blowout quarter. Now, revenue growth was solid, don't get me wrong, but the real story, the thing that tells you everything you need to know about what's going on here, is all about the bottom line.
Just look at that. That's a nearly 100% jump in net income year over year. I mean, wow. This isn't just a little bit of growth. This is a massive step change in how profitable the business is. And it's coming from a mix of things: stronger lease revenues, some really smart aircraft trading, and even a couple of one-time insurance payouts.
Okay, so here's the full picture, and you can just see the strength across the board. Revenue was up a healthy 5% to $227 million. But look at that net income number, a jump to $57 million. And that adjusted EBITDA figure of $262 million, that just shows you the powerful cash flow engine that's running under the hood and supporting this whole operation.
And when you dig a little deeper into the nuts and bolts of the operation, the execution was just flawless. Lease rental revenue, which is the absolute lifeblood of this business, surged 17%. They kept their planes in the air with a near-perfect utilization rate of 99.7%. They're sitting on a mountain of cash with $2.5 billion in liquidity, and maybe most importantly, they got key upgrades from the credit rating agencies. That means they can borrow money cheaper, which is a huge advantage.
So the big question is, how do they pull these numbers off? What's the secret sauce here? Well, it really all comes down to one thing: a very deliberate and very aggressive fleet strategy. The game plan is so simple, but man, is it effective. Sell old, buy new. I mean, look at this. The planes they sold this quarter were on average 18 years old. The planes they brought in, just 3 years old. It's a massive shift. They're systematically upgrading their portfolio to younger, more in-demand, and much more valuable aircraft.
And this is what that strategy gets you. This is a huge milestone for Aircastle. 50% of their entire fleet's value is now in these new technology jets. Now, this is not just some cosmetic change. It fundamentally changes the risk profile and positions them perfectly for where the industry is heading.
So why is this new tech pivot so important? Well, it's pretty simple. It's about having what everyone wants. These are the planes that the airlines are desperate to get their hands on because they burn less fuel, they have lower emissions, and they're just way more reliable. Aircastle is basically aligning its inventory perfectly with what the market is screaming for.
Now, a great strategy is one thing, but what makes this truly brilliant is the timing. Aircastle is running this playbook in one of the best environments for aircraft lessors that we've seen in a long, long time. It is a classic seller's market out there.
Let's start with demand. To put it simply, people are flying again. A lot. The data shows traffic just keeps climbing. And look at those load factors. That's the percentage of seats filled on planes. They hit a record high in August. The bottom line is, airlines need more planes to meet this demand, period.
So you've got this massive, surging demand. But what about supply? Well, you don't have to take my word for it. The CEO, Mike Inglis, laid it out perfectly. The big manufacturers like Boeing and Airbus are behind on deliveries, and ongoing engine problems are creating a massive supply crunch. There just aren't enough new planes to go around. It's basic economics, and it's driving up the value of every single plane that Aircastle already has.
All right, so the prepared remarks from management were glowing. But, the real juice, the real insights often come out during the Q&A session with the analysts. And they zeroed in on the two biggest questions facing the whole industry right now. First up, a question from JP Morgan. And it's basically the elephant in the room, M&A. The industry is consolidating, with big players getting bigger. So the question is, does Aircastle feel the pressure to go out and make a big deal just to keep up?
And their answer was, pretty telling. They used words like conscious and interested, which is classic corporate speak. But the message between the lines was crystal clear. They feel zero pressure to do a deal. They're confident they can get great returns for shareholders all on their own. Basically, they'll look, but they're not going to overpay for something they don't need.
Okay, next hot button issue, the Spirit Airlines bankruptcy. This is a big deal because it could potentially flood the market with over 100 used airplanes. So naturally, analysts wanted to know if management was worried about this hurting lease rates across the board.
So you'd think this would be a major concern, right? Well, management basically said, don't worry about it. They're confident the market can easily absorb these planes. And a big reason why is that those ongoing engine issues are actually creating a bottleneck
so those Spirit jets won't all come back into service at once. The takeaway is that in a market this starved for supply, the impact should be pretty minimal.
Okay, so let's put it all together. We've got incredible results, a razor-sharp strategy, and a market that's providing some serious tailwinds. So that brings us to the next call. What does this all mean for Aircastle, and where do they go from here?
Now, before I give you our official rating, I just want to be crystal clear about what we mean by our terms. When we say outperform, we mean we expect this company's stock to do better, to generate a higher return than the overall market or its direct competitors over the next year.
So our rating for Aircastle is outperform. It's really the whole package. They have the right fleet at the right time, they have a rock-solid investment-grade balance sheet to fund their growth, and they're executing this plan flawlessly into a market that's hungry for exactly what they're selling. They are perfectly positioned to keep delivering fantastic results. And as always, we have to say it, this is not financial advice.